So this second section, I'm going to talk about the primary forms of business and organization. Okay, so the first type of business is called proprietorship. Okay, so you can see this gentleman. He is a carpenter, right? He will do business, right? It's himself. If I am a customer, I need somebody to build my fence. I will hire him, pay him money, right, to do the fence for me, right? Because my job is to use my brain. I'm not a handyman, right? So I have to rely on a carpenter to do this for me. So the carpenter is on its own, right? So then he just you know just basically sell his time, right? Sell his labor to make money. Okay. So basically, it's easy to set up, right? And this guy will have all the says about how to run the business. He's the only guy. He could hire employees, right? But he's the only boss. This business has limited life. When this gentleman aged, right? He's getting older and older. He has to quit, right? Because his physical health is not good enough to keep this work going, right? So this business, this will have limited life, right? Unlimited liability. So basically, if he's building my fence, okay, and he didn't do it properly, okay, and the fence fall and crushed neighbor's child, right? And the neighbor was really upset, right? They sue me, right? So that's his liability, right? And the liability means if that legal case need to be settled by $2 million, he has to sell all his house, his car, his belongings, probably declare bankruptcy, right, to settle that legal case. So as a proprietorship, you have unlimited liability, okay? And you earn money, you report your earnings as business income in the individual tax return. In Canada, we call it T1, okay? So he will report his income as business income in the T1 return. Okay, so in Canada, there are a lot of people who are running their own business as proprietorship. So partnership is owned by more than one person. Okay, and they need to agree with each other how to divide the profit, right? What are each other's responsibilities and privileges, right? So this is the written agreement, right? It's called a partnership agreement. It has limited life. Okay. So again, the partner basically is the person running this, right? When the partner retired, right? So the partnership has to, when you bring a new partner, you start a new partnership agreement. Each partner has unlimited liability. Okay, and the partner will report income tax income in their T1 return. Can anyone give me example what would be a partnership? What would be a business we know that is a partnership? Sometimes you hear people introduce themselves saying, I'm a partner in a law firm, right? I'm a partner in a law firm. So that tells you that this guy is a boss for a law firm, right? Probably make a lot of money. Sometimes you hear people say, I'm a partner in an accounting firm, right? In an accounting firm. So basically, a lot of the professionals, like lawyers, accountants, and even doctors, right? They form partnership, right? Do you know why? A lawyer, why don't they just be on their own, right? A lawyer open their own firm, he's only boss, right? Accountant has own doctors has his own practice, right? Do you know why these professionals they want to form the partnership, and what do you think the benefit of the partnership would be? Ease the labor. Okay, yeah, that's a good one. So the main reason is to earn higher profit. Yes, by sharing the cost. Yeah. What else? Limited liability. Not really. So partnerships still have unlimited liability. Okay, think about the doctor, right? Loss will be distributed between the partners. Yes. Okay, good. Risk can be divided among partners. Okay. Yeah. So I want you to think about a doctor, right? He wants to take a vacation, right? Every year, he wants to take 1 month vacation. But what about his client, right? What about people who wants to see the doctor, right? So what about the emergency, right? Their capital is more. Yeah. So they can cover each other, right? They can cover each other. So sometimes you go to the clinic, you don't get to see the doctor, um, your doctor, right? Your doctor may not be in that day, but you were assigned to a different doctor, right? Right. But this, if without this partnership, this will not happen, right? If the doctor is not available because he's sick, he's traveling, he has to close his clinic, right? What about other reasons? There's another reason. Think about the benefit of having people together. What would be the other benefit? Sometimes it's about expertise, right? So one partner is good at, let's say, he's a lawyer specialized in family law, right? And another lawyer is specialized in criminal law, right? So if they all, yeah, roles and responsibilities, yes. So if one lawyer, okay, on its own, his scope service will be very limited, right? But when you bring lawyers with different expertise to form a partnership, right? So the partnership will be well-rounded with different areas, right? They can attract people to come in, and when that people have a criminal law problems, and then later on maybe he has a divorce, then they will keep using, right? You can see that they retain share probably the same pool of clients, right? Yeah, the goodwill will be increased by the name of the different partners, right? Basically, the partnership will have enhanced goodwill, right? So very good. So the same idea for accountants and the doctors, right? And to start your own by yourself, you need to have a receptionist, right? You need to rent an office building. These costs are too high, right, for one partner. So they can share with each other one receptionist, right? Because you are not that busy, right? So basically, by working together, right, you can use the same receptionist and share the cost her salary, and one is enough for the three probably because you are not that busy to pick up phone calls every day, right? So that's the idea, right? Okay, so now let's see. Corporation, right? Corporation this will be, so the example will be, who is the boss, right? Corporation, the owner of the shares of the corporation is the shareholders. Shareholders are the boss of the organization. So CEO is the manager, right? It's the executive manager. CEO is just the person run the operation. But the boss are the shareholders. Okay. So if you buy one stock of Apple, you are the shareholders of Apple, but you probably don't have a lot of to say, right? Because the percentage of your ownership is very, very, very minimal, right? It's negligible, right? So basically, you have to hold significant portion of the shares to have a seat in the board of directors, right? The board of directors are actually representing the shareholders, right? To monitor CEO's performance, right? Corporations, for example, would be Disney, right? Would be Disney. So Disney is a corporation. So this corporation, okay, has indefinite life, okay, indefinite life. So the previous owners may passed away, but they sell the shares to the next generation of investors. So as long as they're doing good business, this corporation will carry on forever, indefinite, right? It's easier to raise money, right? If you're a corporation, you sell your stocks, issue stocks in the stock market, and then you raise the money for the corporation to expand. Shareholders enjoy limited liability, right? So basically, if there's a lawsuit against a Disney company, the worst scenario would be Disney company went bankrupted. Okay. And as a shareholder, I lost my investment, but I don't have to sell my personal assets to settle that legal suit, right? So basically, my liability is only limited to the amount of investment into that company as a shareholder. My personal assets, my personal belongings are still protected, right? Are still protected. So that's one of the major advantage of using corporation to do business is that you have limited liability. Corporation will pay corporate tax, which will be a different filing system. We call it T2. So for personal, it's T1. For corporate tax, it's T2. Corporations can be public if the shares are publicly traded, right? Like Apple shares. That's a public company. You can buy Apple shares in the stock market. But it could also be private, right? If you think about Twitter, right? Twitter used to be a public company, right? But it was purchased by Musk, right? So now he made it, he's the only shareholder. He made it to be a private company, right? So if you want to buy the shares of X, you are not able to buy it, right? Because it's not public traded. Does anyone have any question about this? I have two corporations, but all private, okay? Because the limited liability. I have my own accounting firm, okay? So it's not a partnership, okay? So it's my part-time job. I can't commit it my time to do a partnership. So I have a corporation, professional corporation, for my accounting business. I also have an immigration business. Okay, so both are private corporations. So do we have any questions on this? No, let's go on, keep going here. Okay, so here, let's put them together side by side. So then let's compare their similarities and the difference. So proprietorship, partnership, corporation. In terms of ownership, proprietorship is one person show. Partners requires more than one person. Corporations could have tens of millions of shareholders for those big companies. In terms of control, so who is the boss? The owner of the proprietorship is the boss. Partnership, that control is executed through the written agreement. The control of a corporation is through the majority of shareholders. So the decision made by the majority of shareholders would rule, okay? Lifespan. Only corporations have indefinite life because they can easily pass the shares to the future investors. Proprietorship or partnership are heavily relied on the person, the owner. Once they retire, so that organization will have to be terminated. Liability, only corporation will have limited liability. The other two will have subject to unlimited liabilities. Income tax, corporation will file T2, and the proprietorship and the partnership will file T1. Okay, file T1. Any questions on this? Any of you want to start a business? Starting your own business will means a risk for you, right? Because there's a lot of risks that beyond your control, right? You're running a restaurant, but then all of a sudden COVID came, right? Nobody wants to go, nobody there to sit in the restaurant to eat, right? And you never think things like this will happen, right? So running your own business, you have to bear risk, but you have the return, right? So many of you are finance major, right? I'm pretty sure you understand the point that high risk, high return, right? If you don't want to take risk, then just be an employee, right? Employee means you just take a paycheck every month, right? And it's really hard to negotiate for salary raise, right, with your employer. You know, the inflation is so high, boss, please give me some raise, right? Give me a good raise, but you probably won't get it, right? But if you are doing business, right, inflation is high, you probably can just increase the price of your product or service to compensate for that inflation, right? So yeah, so depending on how well you can cope with risk, you may want to start your own business, or you will probably just want to be an employee. This is my last slide for today. We're almost done. Okay, 4 minutes, 4 minutes to go. So when people prepare financial informations, if one person go with one way, the other person with another way, as external users, it's hard for me to compare the two financial statements, right? You cannot compare apples with orange, right? So the idea is we have to compare apples to apples for me to make a decision, right? I only have so much money. I could either invest into A corporation or invest to B corporation, right? So I have to make an evaluation and make a decision which company I'm going to invest, right? So when I'm comparing A and B, right? So they have to use some kind of similar accounting standard guiding them to prepare the information, right? Because otherwise I can't make any decision. So that's what is coming. We call it, we call these rules, okay, for the preparation of financial statement, generally accepted accounting principles. In short, GAAP, GAAP, okay? Generally accepted accounting principles. So the major ones available in Canada is the IFRS. So this is called International Financial Reporting Standards. If you are a public traded company, okay, you have to use IFRS. You have to adopt this standard. And you can imagine, right? Because there are millions of users for this financial statement. So the standard tends to be more rigid, more strict. It's going to take more time to prepare this statement under IFRS. It's going to cost you more money to hire professionals to prepare the financial statements under IFRS. However, private corporation, they could use accounting standards for private enterprises, ASPE. But the reason for that is there are limited number of users, external users, right? So because their shares are not traded publicly, so the owner probably only need financial information to present it to the bank, right? To ask for loans, right? So maybe the external user would be mostly the lender, the banks. So in that case, the risk is low because you have limited set of external users. So the risk is low. Therefore, the ASPE, the ASB, tends to be looser, right? Less restrict, easier to prepare compared to IFRS. Okay. So as a public traded company, you have to adopt IFRS. But for private corporations, you have the option to use ASB if you want to save some money, right? Proprietorship and partnership generally follow ASB for external reporting. Okay, if you use it for internally, if it's just internal use, you don't have to follow any standard. If it's only for internal use. Okay, so we're time. Okay, it's 5:45. So if you have a question, please stay. Otherwise, class is dismissed. I will see you guys on Monday, January 8th. Have a good evening, everyone.